You ever look at the headlines and just feel completely whipsawed? I mean, one story says the economy is on the brink, and the very next one says things are looking great. So, what are you supposed to do with your money when the news can't even get its story straight? Well, that's exactly what we're going to break down today, a clear strategy for these confusing times. Okay, so here's the exact puzzle we're trying to solve. In one corner, you've got the threat of a US government shutdown. That's a classic sign of instability, right? But then in the other corner, the Federal Reserve is cutting interest rates, which is something they do to get the economy growing. These two things are telling you the complete opposite. So where do you go from here? What's the move? You don't panic. You build a plan. And look, this isn't just any old plan. We're talking about a dual-purpose strategy here. It's designed to do two things at once: defend your money, and at the same time, be ready to go on the attack when an opportunity pops up. This isn't about reacting to scary headlines. It's about having a solid philosophy for a market that feels, well, shaky. And really, this whole philosophy boils down to one simple but powerful phrase: defend when you must, attack when you can. It's all about being smart and, maybe more importantly, flexible. You protect what you've got when things feel uncertain, for sure, but you're also keeping your eyes peeled, ready to jump on those opportunities that other people, paralyzed by fear, are going to miss. All right, so let's talk defense. How do you actually do that? You do it with what are called risk-off assets. And honestly, the best way to think about these is like your financial shield. We're talking about stuff like government bonds and gold, assets that tend to hold their value or sometimes even go up when everyone else is hitting the panic button. They're your stability. Okay, so that's the shield. Now, what about the attack part of the plan? Well, for that, you need risk-on assets. And if the other assets are your shield, these are your sword. This is where things like stocks come in. The assets that have huge potential for growth when the economy is humming along, but are also the first to feel the pain in a downturn. It's all about having both. All right, theory is great, but let's get down to brass tacks. How does this whole shield and sword philosophy actually look inside a real-life investment portfolio? This is where it all comes together. So, take a look at this. This is the current breakdown. And what do you see? It's almost a 50-50 split, but it's tilted just a little bit toward defense, 53% risk off. But, and this is key, there's still a massive 47% in risk on assets, ready to grow. So yeah, the strategy is cautious, but it is definitely not sitting on the sidelines. Okay, so let's pop the hood on that defensive 53%, the shield. It's pretty much built on classic safe haven stuff. The biggest chunk you can see is in TLT. That's just an ETF that tracks long-term US government bonds. The rest of it, it's in gold, held through a couple of different ETFs, GLD and IAU. Now for the other side of the coin, the attack side. That 47% is mostly in SWDA, which is a big, broad ETF that holds stocks from all over the world. Then it's got a few individual company stocks sprinkled in, like Vovo and Moody's. This part is really the engine of the whole portfolio, the part that's designed to really perform when the market feels good. Okay, now this is the really cool part. The secret sauce is how these two halves, the shield and the sword, actually work together. It's called the pivot strategy. So imagine the stock market takes a nosedive. What happens? Well, your safe havens, the bonds and gold, they'll likely go up in value. So what do? You sell a little bit of those winners, and you use that cash to buy up stocks while they're cheap. That is literally what attack when you can means in practice. You're buying low. But look, a really smart strategy isn't just about what you own right now. It's about thinking ahead and planning for what might happen next. So let's take a peek at how this investor is actually thinking about the future. Now, to be crystal clear, this is not a shopping list for right now. Think of it as a watch list. This investor is keeping an eye on more bonds, another global stock fund, and even some real estate funds, or REITs. But they're not buying yet. Each one of these is being monitored for the perfect time to get in, depending on what the market does. It's all about being proactive, not reactive. And this is really fascinating. This table gives us a direct look inside the investor's brain. Instead of just, guessing, they've actually mapped out three possible futures: a soft landing for the economy, a full-blown recession, and a period of high inflation. And look, they've even assigned a probability to each one and what they think the portfolio would return. This kind of structured thinking is what keeps you disciplined and stops you from making emotional decisions. So what does all that math and all those scenarios boil down to? You get this number, an expected return of about 7% per year. But here's the most important part of that sentence: with controlled risk. See, the goal here isn't to hit a home run every single time. It's to get solid, steady returns while making sure you're protected if one of those worst-case scenarios actually happens. Okay, so we've gone through a lot here. The assets, the scenarios, that whole pivot strategy. So what's the one big idea? What's the main thing you should walk away with after all of this? It's this right here. The shutdown is noise. The rates are the real signal. Think about it. All the political drama around something like a government shutdown, it creates terrifying headlines for sure, but it's usually just short-term noise. The real signal, the thing that tells you about the deep, fundamental health and direction of the economy, is what the Federal Reserve is doing with interest rates. That's what really matters. And that kind of leaves us with one final question to think about. We are all swimming in a constant flood of news every single day, and it is so easy to get distracted by all the noise. The real challenge, and maybe the real key to making smarter decisions, is learning to stop and ask yourself, in all of this, what's the real signal that I should be paying attention to?